Hello everyone, welcome to our video. My name is Eva Sari Manalu and my friend Anissa Pujianti. Today we're gonna explain about the overview of financial statement analysis. What is financial statement analysis? Financial statement analysis is the application of analytical tools and techniques to general purpose financial statement and related data to derive estimates and inferences useful in business analysis. Financial statement analysis reduces reliance on hunches, guesses, and intuition for business decision. Business analysis. Business analysis is the evaluation of company prospect and risk for the purpose of making business decision. This business decision extend to equity and valuation, credit risk assessment, earning prediction, audit testing, compensation negotiation, and countless other decisions. Business analysis aids in making informed decision by helping structure the decision thus through an evaluation of company business environment, its strategies, and its financial position and performance. Types of business analysis. First, credit analysis. Creditors lend funds to company in return for a promise of repayment with interest. This type of financing is temporary since creditors expect repayment of the funds with the interest. Creditors lend funds in many forms and for a variety of purposes. Trade or operating creditors deliver goods or services to company and expect payment with a reasonable period, often determined by industry norms. And then non-trade creditors provide financing to company in return for a promise, usually in writing, of repayment with interest, explicit or implicit, on a specific future dates. And then credit analysis is the evaluation of creditworthiness of a company. Creditworthiness is the ability of a company to honor its credit obligation. Or stated differently, it's the ability of company to pay its bill. And then credit analysis focuses on downside risk instead of upside potential. Liquidity is a company ability to raise cash in short term to meet its obligation. And then solvency is a company long run viability and ability to pay long term obligation. It depends on both company long term profitable and its capital financing structure. And then equity analysis. Equity investors provide funds to a company in return for risk and rewards of ownership. Equity investors are major providers of company financing. Equity financing, also called equity or share capitals, offers a cushion of or safeguard for all other forms of financing that are senior to it. Technical analysis. Technical analysis or charting searches for a pattern in the price of volume history of a stock to predict future price movement. And then fundamental analysis, which is more widely accepted and applied, is the process of determining the value of company by analyzing and interpreting key factors for the economic, the industry, and the company. And then intrinsic value is the value of company or its stock determined through fundamental analysis without reference to its market value or stock price. Other uses of business analysis, there's mergers, acquisition, and divestitures, financial management, directors, regulators, labor unions, and customers. And then business environment and strategy analysis. Analysis of a company future prospect is one of the most important aims of business analysis. It also a subject and complex task. To effectively accomplish this task, we must adopt an interdisciplinary perspective. This is the component process of business analysis. There is industry analysis, strategy analysis, and others. Industry analysis. Industry analysis is the usual first step since the prospect and structure of its industry largely drive a company's profitability. Industry analysis is often done using the framework proposed by Porter 1980 and then 1985 or valuation analysis. And then strategy analysis is the evaluation of both a company's business decision and its success at establishing a competitive advantage. Accounting analysis. Accounting analysis is a process of evaluating the extent to which a company accounting reflects economic reality. Accounting principles are governed by standard. The complexity of business transactions and events make it impossible to adopt a uniform set of accounting rules for all company and all time period. This accounting limitation affect the usefulness of financial statement and can yield at least two problems in analysis. First, lack of uniformity in accounting leads to comparability problem, and then second, discretion and imprecision in accounting can distort financial statement information. This distortion occur in at least three forms. First, managerial estimate can be subject to honest error or omission, and then managers might use discretion in accounting to manipulate or window dress financial statement, and then accounting standard can give rise to accounting distortion from a value to capture economic reality. These three types of accounting distortion create accounting risk in financial statement analysis. Accounting risk is uncertainty in financial statement analysis due to the accounting distortion. Then financial analysis. Financial analysis is used to financial statement to analyze a company's financial position and performance and to assess future financial performance. Several questions can help focus financial analysis. One set of questions is future-oriented. For example, does a company have resources to succeed and grow? Does it have resources to invest in new projects? What are its source of profitability? And what is the company future earning power? Financial analysis consists of three broad areas: profitability analysis, risk analysis, and analysis of sources and use of funds. Profitability analysis is evaluation of company return of investment. Risk analysis is the evaluation of company ability to meet its commitment. And then valuation. Valuation is the main object of many types of business analysis. Valuation refers to process of converting forecasts of future payoffs into estimated of company value. To determine company value, an analyst must select a valuation model and must also estimate the company cost of capital. And then prospective analysis. Prospective analysis is the forecasting of future payoffs, typically earning, cash flow, or both. Financial statement analysis and business analysis. It is emphasized that financial statement analysis is a collection of analytical processes that are part of business analysis. Financial statement, basis of analysis. Business activities. A company pursue a number of activities in desire to provide a sellable product or service to yield a satisfactory return on investment. Its financial statement can relate disclosure inform us about the four major activities of company: planning, financing, investing, and operating. It is important to understand each of these major business activities before we effectively analyze a company financial statement. And then plan activities. A company's goal and objective are captured in a business plan that describe the company purpose, strategy, and tactics for its activity. A business plan assists manager in focus their effort and in identifying expected opportunity and obstacle. Insight to the business plan considerably aids our analysis of company's current and future prospect and is part of analysis of business environment and strategy. Financing activities. A company requires financing to carry out its business plan. Company needs financing for purchasing raw material for production, paying its employee, implementing marketing campaign, and research and development. Finance activities refer to the method the company used to raise the money to pay for these needs. And then investing activities. Investing activities refer to a company acquisition and maintenance of investment for purpose of selling product and providing services, and for the purpose of investing excess cash. Investment in land, building, equipment, legal right, like patent, license, and copyright, inventories, human capital, information system, and similar assets are for the purpose of conducting the company's business operations, such as asset or called operating asset. Also, companies often temporarily or permanently invest excess cash in securities, such as other companies' equity stock, corporate and government bonds, and money market funds, such as asset are called financial asset. Operating activities. One of the more important areas in analyzing company is operating activities. Operating activities represent a carrying out of the business plan, give its financing and investing activities. Operating activities involve at least 5 possible components: research and development, procurement, production, marketing, and administration. How the company does is devising business plan and strategies and deciding the mix of operating activities to determine its success or failure. Analysis of earning figures and their component parts reflect a company's success in efficiently and effectively managing business activity.
Hello everyone, we will continue with me, Anissa Pujanti. We will tell the material about financial statements reflect business activities. As we know that financial statement is a statement that made at the end of period, typically a quarter or a year, that prepared to report on financing and investing activities at a point in time, and to summarize operating activities for the preceding period of any business. In running business activities, some organizations have to make planning. Good planning will affect the good financial statement, and at the reverse. In running the business activities, we have to maintain our investing, operating, and the financing of our company. The first, our investing, is we invest our fund into the asset that consists of current asset and non-current asset, such as cash, inventories, marketable securities, and land, buildings, equipment, patent, etc. And operating activities, we have to maintain our sales, and then we have to calculate and maintenance our expense about administrative expense or operating expense to know our profit or our loss in one period. And then for financing activities that is a search to finance our business. This financing source come from two types. The first type is from the owner's equity or our self fund, and the second is come from the liability, such as we loan from the bank, that is consists of current liability and non-current liability. And then the series in preparation of the financial statement. The first series is balance sheet. Balance sheet or accounting equation is the basis of the accounting system. whereas we have to maintain assets is equal to liabilities and plus equities. And then income statement. Income statement is a financial representation of the operating activities of a company that measure the company's financial performance over a period of time. Income statement is equal to the net income that includes all of income during period minus expense that includes all of expense during period. And the third is statement of change in shareholders' equity. That is, statement contains of details and reason for change in equity holders' claim on the asset of a company. It shows us the beginning of capital until the ending of the capital during period. And the last is statement of cash flows. Statement of cash flows shows as how change in balance sheet, accounts, and income that affect cash and cash equivalents, and it breaks the analysis down to the operating, investing, and the financing. Now, financial statements are not the sole output of a financial reporting system. Additional information about a company is also communicated. A true financial statement analysis involves examining this additional information. The first is Management Discussion and Analysis, or MD&A. Companies with publicly traded debt and equity securities are required by the Securities and Exchange Commission to file a management discussion and analysis. The management must highlight any favorable or unfavorable trends and identify significant events and uncertainties that affects a company liquidity, capital resources, and the result of operation. The second is management report. The purpose of management report are to reinforce: the first is senior management responsibility for the company's financial and internal control system, and the second is the shared roles management directors and the auditor in preparing financial statement. And the third is audit report. Financial statement analysis require a review of the auditor's report to ascertain whether the company received an unqualified opinion. Anything less than a qualified opinion increases the risk of analysis. And the next is explanatory report. Explanatory notes or report is notes that communicating additional information regarding item included or excluded from the body of the statement. The technical nature of notes creates a need for a certain level of accounting knowledge on the part of financial statement analysis. Explanatory notes include information on accounting principles and methods employed, detailed disclosure regarding individual financial statement items, and the commitment and the contingency and the business combination. And then supplementary information. Supplementary information include supplemental schedule to the financial statement notes, include information on the business segment data, export sales, marketable securities, valuation account, etc. And the last additional information is proxy statement. A proxy statement contains information necessary for shareholders in voting on matters for which the proxy is solicited. Proxy statement contains a wealth of information regarding a company, including the identity of the shareholders owning 5% or more outstanding shares, biographical information on the board of directors, compensation arrangement with officer and directors, employee benefit plans, and certain transactions with officer and directors. And then this is the third subtopic of our material, that is financial statement analysis review. Financial statement analysis preview is analyzing financial statement is an activity doing by some parties that needs to know our business activities performance. To preview the analysis, we need analysis tools that includes first, comparative financial statement analysis. Second, common size financial statement analysis. Third, ratio analysis. Fourth, cash flows analysis. And the last is valuation. We will tell about the first analysis, that is comparative financial statement analysis. The purpose of comparative financial statement analysis is comparative financial analysis is a review about consecutive balance sheet, income statement, or statement of cash flows from period to period. This usually involves a review of change in individual account balance on a year-to-year or multi-year basis. The most important information often revealed from the comparative financial statement analysis is trend. The objective is a comparison of statements over several periods can reveal the direction, speed, and the extent of a trend. Comparative analysis also compares trend in related items. And the technique to do comparative financial statement analysis is have two techniques. The first is year-to-year change analysis, and the second is index number trend analysis. And then the second analysis is common size financial statement analysis. The purpose of common size financial statement analysis is the first, evaluation of internal makeup of financial statement, and the second is evaluation of financial statement accounts across a company. The objective to common size analysis of a balance sheet is often extended to examine the accounts that make up specific subgroups. And what is the output? The output is the proportional side of assets, liabilities, equities, revenues, and expenses. And the third is about ratio analysis. The purpose of ratio analysis is to evaluate relation between two or more economically important items, one starting point for further analysis. And the output is mathematical expression of relation between two or more items. And the caution is prior accounting analysis is important, and then interpretation is the key, and then long versus short term and benchmarking. And then the fourth is cash flow analysis. The purpose of cash flow analysis is to evaluate the sources and the use of funds. The term is cash, and the objective of cash flow analysis is cash flows provides insight into how a company is obtaining its financing and deploying its resources, and then also used in cash flow forecasting and as part of liquidity analysis. And the output is show the pattern of the company on taking in and paying out the cash. The last analysis is about valuation models. The purpose of valuation models is to estimate intrinsic value of a company or a stock of the company. And the basis is we use present value theory or time value of money. In doing valuation model, we have four valuation. The first is debt or bond valuation that have formula BT equal to IT plus 1 per bracket 1 plus R bracket square 1. And we can see together is the formula. I will continue. The second is equity valuation. That is make the valuation about the dividend, the cost of capital, and then expected dividend. And then the second valuation is about equity valuation minus free cash flow to equity model that have the formula explain about the free cash flow in the period, and then the cost of capital, and then expectation of the analysis. And then the last is equity valuation minus residual income model. They tell about the book value at the end of the period, the residual income, and then the net income, the cost of capital, and also the expectation to the future. And then the last material for me is about analysis in an efficient market. The efficient market hypothesis is used for short deals with direction of market prices to financial and other financial information. And then in the market efficient analysis, there are three assumptions from of the market efficiency. There are weak form, where the price reflect information in past price, and semi-strong, where the price reflect all public from information, and then strong form, where the prices reflect all public and private information. Okay, that's all of the material from our groups. Sorry if we have any mistake. You can correct in a comment. Thank you for watching. Assalamualaikum warahmatullahi wabarakatuh.